Right now, there are people your age sitting on six-figure portfolios, and they didn't inherit it. They didn't win the lottery. They just started early with something simple, something almost anyone can access with $50 and a phone. Meanwhile, millions of Americans keep their life savings in a checking account, earning basically nothing, watching inflation quietly eat away their future. The gap between those two groups isn't luck, it's knowledge. And by the end of this video, you'll know the one investment that builds more long-term wealth than almost anything else on this list. Stick around, because number one might completely change how you think about money. Investing can feel intimidating. Stock tickers, jargon, endless warnings about risk. It's no wonder so many beginners just avoid it altogether. But here's the truth. You don't need to be a Wall Street expert to start building wealth. You just need to understand your options. Today, we're counting down 10 investments every beginner should know, starting with the accessible ones and building toward the one that could define your entire financial future. Let's get into it. Number 10. High-yield savings accounts. This isn't glamorous, but it's foundational. A high-yield savings account pays significantly more interest than a traditional bank account, often 10 to 20 times more. Say you keep $5,000 in a regular savings account, earning 0.1%. That's $5 a year. Move it to a high-yield account earning around 4%, and you're looking at $200 a year, doing absolutely nothing extra. It's not going to make you rich, but it's the safest place to build your emergency fund before you start investing elsewhere. Once that safety net is in place, you're ready for something with more growth potential. Number 9. Certificates of deposit, or CDs. A certificate of deposit is a fixed-term deposit at a bank. You lock your money away for a set period, say 6 months or 2 years, and in exchange, you get a guaranteed interest rate. Banks across the country offer CDs with rates that beat regular savings accounts. The catch? Pull your money out early, and you'll pay a penalty. CDs work well for money you know you won't need soon, like a house down payment you're saving for in 18 months. They're predictable and low risk, which makes them a nice stepping stone toward market-based investments. Number 8. Treasury bonds. When you buy a U.S. Treasury bond, you're essentially lending money to the federal government. In return, the government pays you interest over time. Treasury bonds are considered one of the safest investments in the world because they're backed by the full faith and credit of the United States. You can buy them directly online in amounts as small as $100. They won't make you rich overnight, but they add stability to the portfolio, especially when stock markets get shaky. Think of them as the calm, steady friend in your investment lineup. Number 7. Index funds. Now we're getting into serious wealth-building territory. An index fund is a basket of stocks designed to track a market index, like the S&P 500, which represents 500 of the largest U.S. companies. Instead of picking individual winners, you own a small slice of hundreds of companies at once. Historically, the S&P 500 has returned about 10% annually before inflation over the long run. A 25-year-old who invests $300 a month into an index fund could realistically retire with over $1 million by 65, thanks to compound growth. Quick question for you. If you started investing today, where do you think you'd be in 20 years? Drop your answer in the comments. Number 6. Exchange-traded funds, or ETFs. ETFs are close cousins of index funds. They also bundle multiple investments together, but they trade on the stock exchange throughout the day, just like individual stocks. This gives you flexibility. You can buy an ETF that tracks the entire market, one that focuses on technology companies, or one that targets renewable energy. ETFs typically come with low fees and require no minimum investment beyond the share price. For beginners who want variety without picking single stocks, ETFs offer an easy entry point into dozens of sectors at once. Number 5. Individual stocks. Buying a share of a company means you own a tiny piece of that business. When the company grows and profits, your investment can grow too. Think about someone who bought shares of a major tech company back in the early 2000s and held on. That patience turned modest investments into life-changing returns. But individual stocks carry more risk than funds because your success depends on one company's performance instead of hundreds. They can be a powerful tool for building wealth, but they work best as part of a diversified strategy, not the whole plan. Number 4. Real estate. Real estate has created more American millionaires than almost any other asset class. This doesn't just mean buying a house to live in. It includes rental properties, house hacking, where you rent out part of your home to cover the mortgage, and real estate investment trusts, which we'll cover next. Property values and rents have historically trended upward over decades, and real estate offers unique tax advantages too. The barrier to entry is higher than stocks, since you typically need a down payment. But the long-term payoff for patient investors has been substantial. Number 3. Real estate investment trusts, or REITs. If owning physical property feels out of reach, REITs let you invest in real estate without buying a building yourself. A REIT is a company that owns income-producing properties, like apartment complexes, shopping centers, or office buildings, and it's required by law to pay out most of its profits as dividends. You can buy shares of a REIT through a regular brokerage account, sometimes for less than $100. It's a way to add real estate exposure to your portfolio with none of the headaches of being a landlord. Number 2. Employer-sponsored retirement plans. If your job offers a 401k, pay close attention here. Many employers match a percentage of what you contribute, essentially handing you free money. Say your company matches 50% of your contributions up to 6% of your salary. If you make $60,000 a year and contribute 6%, that's $3,600 from you, plus an extra $1,800 from your employer, completely free. Turning down that match is like turning down a raise. On top of that, contributions often lower your taxable income today, while your money grows tax-deferred for decades. And here's number 1, the biggest secret nobody tells beginners. The specific investment matters less than the habit of investing consistently over time. Someone who invests $200 a month for 30 years through market crashes, recessions, and recoveries will almost always outperform someone who tries to time the perfect moment to invest a lump sum. This is the power of dollar-cost averaging combined with compound interest. Money invested in your 20s has decades to grow, doubling and redoubling through market cycles. A modest, automatic monthly contribution, left alone and increased slightly every year, is the single most reliable path to financial independence that exists. It's not flashy. It won't trend on social media. But it works every single time for anyone disciplined enough to stick with it. Building wealth isn't about finding some secret stock tip or perfectly timing the market. It's about understanding your options, starting early and staying consistent. Every investment on this list has a place in a smart financial plan. But the habit of investing regularly is what actually changes lives. Your future self is counting on the decisions you make today. If this video helped you understand investing a little better, hit that like button and subscribe to Wealth Countdown for more finance breakdowns like this one. Tell us in the comments which investment you're starting with, and turn on notifications so you never miss the next countdown.